we get into an exchange, or exchanges, also called a 1031 exchange, also known as a Starker exchange. Then the 1031 and the Starker names come from a couple of things. This law came about in the early 1900s. A CPA with the last name of Starker went to the Supreme Court and fought over what's known as the Tax Code 1031, over how it was applied and all that. And the Supreme Court ruled in favor of Starker. That made it basically what I'm getting ready to tell you this to be. So that's where the name Starker comes from. It's the CPA that helped fight for this thing, and 1031 is the IRS code that deals with exchanges. So what this is, what these exchanges are, is that it recognizes that I buy a property. Using the same example, I bought it for 80, sold it for 100. So I made a $20,000 gain. Forget the calculation we just did. Let's just say that the capital gain was $20,000. If it's short term, I'm paying one rate, long term, I'm paying another rate, whatever that is. What if I could just avoid paying that tax altogether? Who cares if it's short or long term? Just, I made $20,000 and I get to keep all of it for a minute. Is that nice? And I think it is. So what I can do is go through what's called a Starker 1031 exchange program that allows me to defer the tax payment on this. So what I'm doing is I'm taking the $20,000. I sell the home that I bought for 80 and selling it for 100. What I do is I take that $20,000, and that $20,000 does not come to me. I do not take possession of that money. Instead, it goes to a third-party intermediary that holds it for me. Sometimes that might be a title company. There are people that are related to these 1031 exchange programs, so they have to be educated in this process. But there are title companies that'll do it. There are third-party companies that'll do it. Bottom line is it's somebody that is qualified to do this, but not me. So I didn't get the $20,000. This third-party intermediary is holding this money for me. From there, now I have a couple of time frames. I have a couple of calendar days to keep up with. The first one is that once I have sold that first property, I have 45 days from that date to identify, to decide, or to pick up to 3 properties that I want to buy with that $20,000. So again, that money's out there, held by that third-party company, and I'm trying to decide, what am I going to do with that? Am I going to buy this strip center? Am I going to buy this residential property? What am I going to do with it? I have 45 days from the date of closing the property I made the money on to decide between one of 3. One of these, 1, 2, or 3 properties I'm going to buy. Maybe I buy all 3, it doesn't matter. I can choose up to 3 properties. Within 180 days of closing on that first property, I have to close on one of the 3 properties that I identified within within that first 45 days. 180 days. So I have to close on it on one of those 3 that I picked within the first 45. I have to close on it within 180 days. The IRS is very specific on those dates, 45 and 180. 45 to identify, 180 to close. If the 45th day or if the 180th day falls on Christmas, it still counts. So it's calendar days. It's not Sundays. We don't worry about those. We don't, not holidays. It's a straight 45, 180 days, regardless of what day it falls on. It's going to count. So they're very specific on that. If I comply with those rules, having it held by a third-party intermediary, identifying a property or 2 or 3 within 45 days, closing on one of those 1, 2, or 3 properties within 180 days, that money, when I go to buy the second home, the $20,000 then gets pledged to that closing. So again, I never took possession of it. It went from the initial closing where I got the money and it went to that third-party company to the point where I bought the second home. The money went from there toward that property. Never touched me. So as a result of that, I did not take a gain on that property. So in that case, I defer the tax that I would have paid on that $20,000. Now the trick to this, or not the trick, but something to be mindful of to this, is that the 1031 exchange is only a deferral of the tax. It will catch up to you. It's not an elimination. That is very important to understand. It defers the tax. Eventually you'll have to pay it, but it defers it to a future time period, and so there's benefits in that. One of which is that maybe I can defer it far enough out to the point where my tax rate is 12%. Right now my tax rate might be 36%. So if I took that $20,000 and took possession of it, I'm going to have to pay 36% on that, which is a chunk of change. Or I defer it out to 20 or 30 years from now when I'm retired, I don't really have an income, I sell that property, I get that income from it now, and I'm at a 12% tax bracket. So now I'm only paying 12% on it instead of 36%. I just saved myself like 20+%. That's sexy, guys. So that's something that we look at. Another pro and con here, depends on if you look at it glasses half full, glasses half empty. We all acknowledge, hopefully, that we're all going to die at some point. I don't want to, I'm not looking forward to that day. Hopefully it's a long time away from me. Same for all of you. But eventually we're going to die. One of the other benefits of this 1031 exchange is that we only pay the tax ultimately when we sell the final property. After we're done with the investing, we're done, we're out of this thing. I want to get out of it, I just want my money, and I want to retire in Key West. On that date, that's the date that I have to settle up with the IRS. What if I don't ever settle up? What if I don't ever sell? And instead, I die. When I die, what happens on my death is that all the things that I own, including the real estate, goes to what's called a stepped up tax basis. Meaning that when I pass, my heirs, my kids, my wife, they will get my estate. And they will get my estate at the value of what it is when I died, not when I purchased it. So I bought this home for $80,000. And I sold it for $100,000, and I made $20,000. So my basis was $80,000. I bought it for $80,000. And after 20, 30 years, this home is now worth $400,000 maybe, $500,000. It's worth $100 zillion. If I sold it in that future, that maybe could be a big capital gain issue. But instead, I 1031 exchanged it, so I didn't take that money. I held on to it. I pass away. When my kids get that property, when whomever is in my estate gets that property, they get it at the value on the date of my death, not what I paid for it. So if that home was worth $400,000, if I had sold it, I would have had a big capital gain. But I passed away. My estate gets that value, gets that property at $400,000. They sell it for $400,000. The capital gain is zero. This is a fantastic investment vehicle for long-term investment properties. An idea, something that I do, not to say that you have to do this too, but just as a suggestion, is that one of my retirement plans includes this thing. And so it's a long-term process. I have hand-picked investment properties that I'm currently renting in ideal areas that I feel are going to stand up for a long period of time. And I've bought them with these 1031 exchange programs in some cases. I'll have all these properties paid off within the next 5 to 10 years. So at the end of 10 years, I'll never retire, but maybe I don't have to worry about investing as much anymore, dealing with that. So in 10 years, they'll all be paid off, they're all renting, so they're cash flowing like crazy. I should have between 20 and 30 properties roughly in about 10 years, all paid off. Each of them earning probably about $1,000 to $1,200 a month on average. Take $1,000 times 20 or 30. You get $20,000 or $30,000 a month of income. I don't know about you. I can live on $30,000 a month. It's rough. It's a struggle. I think I can live on that. And again, it's an overgeneralized statement because you have taxes and you have expenses. I'm going to have to replace roofs, but the point is still there, is that it's a good investment platform for retirement. And then also, guess what? All the money that I use to exchange into these programs, I can sell them at some point. I don't need to. Earning $20,000 or $30,000 a month, I don't need the money to have these properties, so I'm setting them up currently, they're set up in a trust. And when I die, my kids get them. So they're going to have a hell of a portfolio that they're going to inherit that they have to pay no tax on, and a $20,000 or $30,000 a year income for them too, or more at that point. that sexy. And that's the kind of stuff that is possible you guys can do if you just learn some of the strategies, some of these things. In the second paragraph from the top of 266, I have a term highlighted. It's called boot. Everybody see that term boot? So one of the other things that the exchange program recognizes is that if, getting back to my original example, I bought it for 80, selling it for 100, so I made $20,000. Let's say that instead of exchanging all the 20,000, that I want to pull out 5. I want something for my reward, or I put in some effort here, so I'm only going to exchange $15,000 of it. So that part, I'm deferring the tax, but the $5,000 that I pull out of it is what we call boot. And we pay tax on the boot. So it's the money that did not go into this process. So in my example, I earned the 20, put 15 into the next one, and kept 5 for me. And when I pull that 5 out, that does come into my account. It is my money, so I would pay tax on that. Just struck me, but another benefit of a 1031 exchange that a lot of people miss out on is the idea of both leveraging. I mean, again, there's so many things that are interconnected here. We're talking about leveraging and cash flow and all these things that they're all intermixed. The idea is that if I have that property that I made the $20,000 on, and let's say I don't go through this, exchange program, so I pay tax on that 20. Let's say that I'm at the tax rate of 15%. So that means that out of the $20,000, I'm going to have to pay the IRS $3,000. So in effect, I can only use $17,000 of that money to buy another home. If I only have $17,000, that might change my perspective on what home I'm going to buy next, the repairs I'm going to do, because I'm limited. Or I can exchange all 20, now I have $20,000. And granted, that's not a lot of money, but if you're talking about $100,000, $200,000, this can really start to add up to the point of where, I'm making a $50,000 decision based upon, did I go through this or did I not? And so that changes my perspective on the money that I'm going to borrow, what I'm going to do to this property and all that. Can I use all of the money, all that $20,000, or can I only use 16, 17 of it? So it changes my plan on what I do. And that's something else that needs to be recognized.